when you first pull up a financial chart, there is this incredibly pervasive illusion that the market is just this wild, untamed beast, moving entirely on its own.
Oh, absolutely. It feels like pure organic chaos.
Right. A stock goes up, a stock goes down. You're watching these red and green candles flickering on your screen, and it is just so easy to believe that every single asset is fighting its own, individual localized battle. It's all based on a recent earnings report or some flashy new product launch.
Yeah, and it's incredibly comforting to view the market that way. I mean, we naturally want to believe that a stock is moving solely because of what that specific company's CEO did this morning.
Exactly.
The human brain just loves a good narrative. So we try to boil the entire global market down to this collection of isolated micro-level stories.
But then you pull back the curtain, you zoom out from that 5-minute chart, and you realize there's actually a massive singular hand on the steering wheel. Or, well, more accurately, a hand controlling the fuel lines for the entire global economy.
Welcome to the Franks Report. I am Jessica.
And I am Phil. And today's deep dive is really dedicated to stripping away all that complex, honestly, deliberately confusing financial jargon to explain the core mechanics of the market. We are building this for the complete beginner, and we're focusing heavily on the ultimate puppet master of the global financial system, the Federal Reserve, or as everyone just calls it, the Fed.
Yeah. Our mission today is to pull you out of those micro details and show you the macro reality, because understanding the Federal Reserve is the absolute bedrock of understanding why your charts move the way they do.
Yeah, if you don't understand the rules they're writing, you really can't possibly understand the game you're attempting to play.
Right. You're flying blind.
Exactly. Now, really quick, before we unpack those rules, a reminder to pick up a copy of our book, The Funded Micro, Modern Future Strategies for the Prop Firm Era. Just look for that really striking downward-looking spiral staircase on the cover. You honestly cannot miss it. And make sure to follow the show for all our future deep dives.
We also want to thank our sponsor, TradingView. They really provide the fastest way to follow markets. So if you are looking to obtain their business standard when charting your trades, you can save $15 by using the referral code down in the description.
Okay, so let's get into the actual mechanics of this puppet master. Because the absolute biggest misconception I see constantly repeated is that the Fed somehow sets stock prices.
Oh, yeah, constantly.
Like, people imagine this smoky room full of bureaucrats looking at a screen, literally deciding that a single share of a major tech company should cost, $150 today.
Right, which couldn't be further from the truth. I mean, they do not care about the price of a single share of stock.
Yeah.
What the Federal Reserve actually does is set the price of the currency that those assets are denominated in. So if you are buying a stock, a bond, or a futures contract in US dollars, the Fed controls the underlying cost of acquiring those dollars.
Which naturally brings us to why they're manipulating the cost of dollars in the first place. They don't just do it for fun. They operate based on this specific, legally binding directive they received from Congress, which is known as the dual mandate.
Yes, the famous dual mandate.
Right, and it saddles them with two massive and, quite honestly, constantly conflicting goals. The first is price stability, and the second is maximum sustainable employment.
So let's actually define what those mean in practice, because price stability generally translates to targeting an inflation rate of roughly 2% annually.
Okay.
The Fed wants the purchasing power of the dollar to remain relatively steady and predictable, mainly so businesses can actually plan for the future.
Right, because nobody wants a dollar that buys a loaf of bread today and half a loaf tomorrow.
Exactly. So if inflation starts running hot, meaning your dollar buys significantly less at the grocery store month over month, the Fed is legally obligated to step in and tighten money supply.
Basically, they make money harder to obtain. Because if borrowing money is suddenly expensive, consumer spending slows down. You might delay buying a new car. A corporation might cancel plans to build a new factory. And eventually, that severe lack of demand cools off those rising prices.
But the tension, and this is where things get really difficult, the tension comes from the second half of their mandate, which is maximum sustainable employment.
Right, the growth side.
Yeah, this focuses entirely on economic growth. They are tasked with fostering a labor market where most people who want a job can easily find one. But they have to achieve this without causing the economy to overheat and trigger the very inflation they're supposed to be fighting.
Which seems impossible.
It is a massive balancing act. because if unemployment starts climbing too high, they have to adopt an accommodative stance. They make money incredibly cheap to borrow, essentially practically begging businesses to take out loans, expand their operations, and hire more workers.
You know, I always hear this compared to driving a car with one foot on the gas and one on the brake, but I think we need to make that analogy a little more mechanical to really understand the trader's perspective here.
Okay, how so?
Well, it is not like driving a nimble little sports car. It is like driving a massive, fully loaded freight train down a mountain.
Oh, that's a good way to put it.
Right. You have one foot slamming the gas to drive employment, and the other foot violently riding the brake to cool down inflation.
And you cannot stomp on both pedals at the same time and expect the train to stay on the tracks.
Exactly. To protect one goal, they inevitably have to sacrifice the other. If they need to lock up the brakes to kill inflation, they are actively, intentionally sacrificing economic expansion. They are risking a wave of layoffs.
Yeah.
But if they need to dump fuel into the engine to save jobs, they are risking a catastrophic inflation spike. So, you know that insane volatility you see flashing on your screen during a major policy announcement?
Yeah, the huge candle swings.
Yeah, that is just millions of market participants rapidly trying to reprice which pedal the Fed is about to press.
And the physical mechanism they use to actually press those pedals is the federal funds rate. You really have to think of this as the master valve of global liquidity.
Okay, so let's define the mechanism. The federal funds rate is basically the interest rate at which commercial banks lend their excess reserves to one another on an overnight basis.
Right, because banks are required to hold a certain amount of capital in reserve at the end of every single day. If a bank is short on capital, they borrow from a bank that has excess, and the Fed dictates the target interest rate for those specific overnight loans.
Okay, I'm going to stop you right there because this is exactly where complete beginners just completely tune out.
Fair enough.
Because if this is just some archaic back-end overnight plumbing between mega banks settling them their daily ledgers, why on earth should a retail trader sitting at home in front of a laptop care about that at all?
Because banks do not just absorb increased operating costs out of the goodness of their hearts.
Oh, absolutely not.
Right. That overnight rate serves as the foundational benchmark for the entire global financial system. When the Fed moves that rate up, it creates an immediate cascading ripple effect through every single corner of the economy. The banks immediately pass that higher cost of capital straight down to the consumer.
Meaning a 30-year mortgage suddenly jumps from like 3% to 7%.
Exactly.
Credit card interest rates spike. The rates on multi-million-dollar corporate loans just double overnight.
Which directly annihilates the amount of disposable capital people and businesses have available to deploy. I mean, if your monthly mortgage payment is suddenly $1,000 higher, you have significantly less money to invest in a brokerage account.
Yeah.
You have less money to buy consumer electronics.
Right.
And that shrinks corporate revenues across the board. On the flip side, if the Fed cuts that rate, borrowing becomes practically free. It completely greases the wheels of the economy.
So a company can cheaply borrow $50 million to just buy out a competitor.
Yeah, or a consumer can easily finance a new house, which instantly floods the market with fresh capital.
Now, I do want to clarify one quick point of confusion here because I often see the discount rate mentioned alongside the federal funds rate. And if the Fed funds rate is what commercial banks charge each other, why does the Fed have its own lending facility? Isn't that redundant?
It sounds redundant, but it functions as the ultimate safety net. The discount rate is the interest rate charged to commercial banks for loans they receive directly from the Federal Reserve's own lending window.
Okay.
However, the Fed usually sets this rate higher than the federal funds rate. They want banks borrowing from each other in the open market. The discount window is designed purely as a backstop during periods of severe financial stress, basically to prevent a total banking collapse.
I see. So the daily driver, the true master valve, really remains the federal funds rate. And this ties directly into the concept of liquidity, which, is the absolute lifeblood of active trading. Because liquidity represents the ease with which you can enter or exit a massive position without significantly moving the price of the asset.
Right. And when the Fed keeps interest rates near zero, the market is usually just drowning in cash. The cost of holding cash is essentially nothing, and keeping it in a traditional savings account actually loses you money when you factor in inflation.
Oh, for sure.
So institutional investors take billions in cash and they go hunting further out on the risk curve. They pour money into stocks, commodities, crypto really, just to find any decent return. That monetary easing pushes massive liquidity into the system, creating those steady, upward trending bull markets that everyone loves so much.
Right, everybody's a genius in a zero interest rate environment.
Yes, they are.
But when monetary tightening kicks in, when the Fed aggressively hikes rates, they are essentially turning off the faucet and draining the pool. Money itself becomes expensive.
The hurdle rate skyrockets.
Right.
And for anyone who doesn't know, the hurdle rate is the minimum acceptable return an investor demands to justify taking a risk. If you can get a guaranteed, risk-free return in a U.S. Treasury bond simply because the Fed raised rates, institutional capital abandons the risky stock market.
They just pull their money out of equities and park it in bonds.
Exactly. And this dramatic shift evaporates trading volume and causes explosive volatility in the stock market.
Well, let me ask you this then. If liquidity is drying up across the board, why does that specifically murder high-growth technology stocks while leaving something like a boring utility stock relatively unharmed?
That is a great question. And it brings us to a foundational concept that dictates all asset valuation, the time value of money. Financial analysts and the institutional algorithms that actually move markets, they do not value companies based on what they are doing today.
Okay.
They value them based on the present value of their future cash flows. And interest rates serve as the discount rate in those complex mathematical models.
Okay, let's unpack the math there without making it sound like a college lecture, because that can get dense.
Yeah, let's keep it simple.
Discounted cash flows essentially mean that a dollar promised to you tomorrow is mathematically worth less than a dollar placed in your hand today.
Exactly.
And how much less it is worth depends entirely on the current interest rate. So if a company expects to generate $1 million in profit 10 years from now, that future $1 million is virtually worthless to an investor today if interest rates are sitting at a massive 7%.
Because you could simply take your money today, put it in a risk-free 7% government bond, and easily outperform that projected company profit over a 10-year horizon.
Right.
Therefore, when the Fed raises rates, the intrinsic calculated value of all future corporate earnings just plummets.
I like to think of the securities market like a massive restaurant menu where you are just trying to order the best meal for your capital.
Okay, I like that.
Right. So for years, the safe, risk-free Treasury bond was offering a measly 1% return. It was just a terrible item on the menu. So you happily risked your capital ordering a highly volatile tech stock that offered a 7% potential return.
Yeah, you had to take the risk to eat well.
Exactly. But suddenly the Fed hikes rates. Now, that completely safe Treasury bond is a delicious, guaranteed 5% return with zero risk of food poisoning.
Right.
Why on earth would you continue to risk your money on the volatile tech stock? The risk just no longer justifies the meal.
It doesn't. The bond market literally vacuums capital away from the stock market. And this is the exact mathematical reason why high-growth sectors see catastrophic sell-offs during rate hikes.
Because tech companies are frequently valued on massive earnings that are projected many years, sometimes decades into the future.
Yes. When the discount rate goes up, those distant speculative future earnings get penalized the absolute hardest in the valuation models. It causes those specific stocks to aggressively reprice downward.
Okay, so moving the interest rate is their primary everyday lever. But what happens when changing the cost of money just isn't enough to save a failing economy, and the Fed decides they need to directly intervene in the actual physical supply of money?
That's when they utilize open market operations, which is commonly referred to as FOMO.
Okay.
This involves the buying and selling of government securities in the open market to aggressively regulate the supply of money in the banking system.
Right.
You will usually hear these actions described in the financial press as quantitative easing, or QE, and quantitative tightening, or QT.
All right, let's start with quantitative easing. The Fed decides to buy massive, unprecedented amounts of government bonds. Wait, where did they get the money to buy billions of dollars in bonds? Do they just create digital money out of thin air?
They literally do. They create digital reserves out of thin air and credit the accounts of the commercial banks selling those bonds.
That is wild.
It really is. The money did not exist before the transaction. By buying those bonds, they inject fresh, new money directly into the banking system. This artificially suppresses long-term interest rates and essentially forces investors to take risks. We saw this deployed on a massive scale during the 2008 financial crisis and again in 2020.
Right, I remember that.
Yeah, it provides a massive artificial cushion of liquidity for the financial markets to just rest on.
Yeah, and for an active trader, periods of QE literally feel like playing the game on easy mode. The dips are constantly bought, trends are super steady and participation is just incredibly high.
Absolutely.
But then there's quantitative tightening, QT, which sounds terrifying. It sounds like they're reversing the process and just vacuuming cash out of the room.
That is exactly what they're doing. During QT, the Fed allows its existing massive portfolio of bond holdings to mature without replacing them, or they actively sell them off. The money that banks use to buy those bonds from the Fed essentially evaporates from the system.
Oh.
Yeah, it effectively shrinks the monetary base.
It is basically the tide of liquidity rapidly going out.
And for a trader, QT represents a highly dangerous period where that artificial safety net is completely removed. With significantly less capital sloshing around in the system, the order books thin out. The market becomes highly susceptible to flash crashes or sudden aggressive drops, mostly because the underlying buying support just isn't there anymore.
Which leads to an incredibly fascinating dynamic because it is not just about what the Fed does behind closed doors with interest rates or bond buying. It is about what they say they're going to do months in advance. The entire global market hangs on every single word spoken by a Fed official.
Which is the practice of forward guidance. The Federal Reserve uses speeches and press conferences to actively communicate its future intentions.
Right.
Markets are inherently forward-looking mechanisms, you know. They attempt to price in a rate hike or a rate cut months before the actual policy meeting even takes place.
And this explains an insane paradox that honestly always confused me when I first started watching the markets.
The good news is bad news dynamic.
Yes. You will wake up and a headline will cross the wire saying, unemployment just hit record lows, wages are up, the economy is absolutely booming. Objectively, this is fantastic news for human beings.
Right.
And yet the stock market instantly tanks. Millions of dollars are wiped out in milliseconds by institutional algorithms.
Because if the economic news is too robust, the market immediately assumes the economy is on the verge of overheating. If it overheats, inflation will rise. If inflation rises, the market knows the Fed will be forced to step in and raise interest rates to cool it down.
So good economic news becomes terrible market news purely because the market is anticipating the future punishment of a rate hike.
Exactly.
It really all comes down to classifying the Fed's current sentiment. Like, we constantly hear the terms hawkish and dovish thrown around in financial media.
Yeah, so a hawkish official suggests that the Fed is deeply concerned about inflation. They are aggressive. They are leaning toward raising rates or tightening policy to restrict the economy.
Like a hawk attacking.
Right. And a dovish stance implies the opposite. They are gentle. They are more concerned about promoting economic growth and are leaning toward keeping rates low or actively cutting them.
And you can actually track this shifting sentiment visually, right? Using something called the dot plot, which is this chart the Fed publishes showing exactly where each anonymous official expects interest rates to be over the next few years.
Yes. Everyone monitors this plot, trying to anticipate the holy grail of market speculation, the Fed pivot.
The pivot.
A pivot occurs when the Fed drastically changes its overarching policy direction. So, for example, moving from an aggressive, multi-year campaign of hawkish rate hikes to a sudden pause or even a dovish cut. These pivots reliably mark the most significant turning points in long-term, multi-year market trends.
And the speculation around exactly when that pivot will occur leads to just wild, unpredictable volatility around Federal Open Market Committee meetings.
Oh, absolutely.
But let's zoom out even further for a second. We have been talking about this mainly in terms of the domestic U.S. stock market. But the U.S. dollar is the world's reserve currency, meaning U.S. rate movements trigger massive reactions across the entire globe.
Oh, yeah. The Federal Reserve's policy decisions have a direct, undeniable impact on the fundamental value of the U.S. dollar. In the global Forex environment, capital is ruthless.
Yeah.
It always flows toward the currency that offers the highest real yield. Interest rate differentials between nations are the primary driver of long-term currency valuations.
So if I am an international investor and the U.S. Federal Reserve is aggressively raising rates to 5%, but the European Central Bank is terrified of a recession and keeping their rates at 2%, capital is going to flood across the ocean.
100%. Global investors will aggressively sell their euros, driving the price of the euro down, and buy U.S. dollars, driving the value of the dollar up. They need those dollars to invest in U.S. Treasury bonds that now offer a significantly higher, safer return than the European bonds.
The US dollar shoots up in value, fueled entirely by those high domestic interest rates.
Right.
But a hyper-strong dollar is actually a massive double-edged sword for the stock market. Because if a US multinational corporation builds smartphones in California and sells them in Europe, a strong dollar makes those phones significantly more expensive for European consumers to buy.
Which completely crushes their international sales. Furthermore, the revenue they do manage to generate overseas is suddenly worth much less when they convert those weaker euros back into strong US dollars for their quarterly earnings report.
Oh, wow.
So as a trader, you really must view the Federal Reserve not merely as a domestic actor managing the American economy, but as the central pillar holding up the entire global currency system.
So what does this all mean for you, the listener, trying to navigate the charts tomorrow morning? The biggest takeaway here is that you have to completely stop looking at the Fed as an entity that dictates if your favorite tech stock goes up or down today.
Right. They do not dictate asset prices directly.
Exactly. They dictate the underlying cost of the currency those assets are priced in.
They act as the master valve for global liquidity. Your ability to survive and honestly thrive in periods of intense market volatility depends entirely on your understanding of their dual mandate. You must track their rate decisions, understand whether they are injecting liquidity via QE or draining it via QT, and you have to listen very closely to the forward guidance they provide.
It is the absolute foundation of everything we do in the markets. And if you want to dig deeper into these underlying mechanics and learn how to actually trade around them, make sure you visit www.franksreport.com. Check out our book, The Funded Micro, Modern Future Strategies for the Prop Firm Era, and follow us wherever you listen to your deep dives.
But before we wrap up today's deep dive, I do want to leave you with a lingering, somewhat provocative thought to mull.
Okay, let's hear it.
We just discussed how capital ruthlessly flows to the country, offering the highest interest rates. So if we're entering a new fragmented macro era where central banks globally start fiercely competing against one another, offering higher and higher real yields in an international yield war just to attract capital to their own shores, how will that global battle for liquidity reshape the future valuation of the multinational companies sitting in your portfolio right now?